Hey everyone, Brayden here, coming to you with finally a Disney news update on the latest happenings at the Walt Disney Company. We've got last week's earnings that I finally had time to go through, the ongoing Proxy war. We have everything going on with Iger and Peltz. They both sent out letters to the shareholders, each with very different narratives, campaigning for the votes of the shareholders to shake up the board or keep it the same. Disney CEO Bob Iger is saying that they've made significant progress towards getting the Walt Disney Company back on track, and Disney's dissenting investors, led by Nelson Peltz, says that Disney's story of getting the company back on track is a fairy tale, that it's all smoke and mirrors, and that the shareholders voting at the annual meeting to upset the current board and put some new people on it is essential to turning things around at Disney. By the way, we now know Disney's annual meeting of the shareholders will be held on April 3rd, 2024. It's shaping up to be an eventful one, with Disney putting resources towards setting up a website and releasing videos telling shareholders to approve their board nominees, and meanwhile Peltz is doing the same thing. He's got his website where he has a video telling shareholders to nominate himself and the former Disney CFO, Jay Rizzullo, who is running with him, nominate them to the board instead. First, a quick recap of last week's Q1 2024 earnings report. I was out on assignment working on another video at the time, so apologies for the big delay with getting to these numbers here. The headline with Disney's Q1 earnings report was that they posted results exceeding analyst expectations, and handsomely so. Earnings per share beat analyst estimates by 23%, which is pretty significant. In addition to this, Disney is increasing their cash dividend for shareholders by 50%. Disney even did something they hardly ever do, which is provide guidance for this new fiscal year's earnings per share, what it will be by the end of the year. They expect EPS to be 20% better this fiscal year than last fiscal year. The parks are continuing to make hand over fist, of course, with experiences revenues up 7% versus the same quarter last year, largely thanks to improved results at the international parks, as well as the expanding cruise line business. Also, and I think this was highly pivotal to the reception of this earnings report, operating losses at the direct-to-consumer businesses, together they saw a meaningful trimming of those operating losses, which I think is something that a lot of the shareholders liked to see. If you really dig into it here, some of these figures aren't quite impressive as they seem. However, in aggregate, Wall Street was very happy with this report. With Disney's stock ripping, it is up 23% so far this year, as of the recording of this video. This incredible reaction to Disney's earnings report definitely also had something to do with an announcement that was made alongside it, that the board had approved a $3 billion share buyback program. Adding to Wall Street's positive response to the earnings was one particular announcement Bob Iger made the day of the earnings on CNBC. Take a listen.
We've entered into a strategic relationship with Epic Games, the maker of Fortnite, to not only invest in the company Epic, we took a minority stake, but we're also creating with them a huge Disney universe that will be for gaming and for play and for watching and even for shopping, for digital goods and maybe ultimately physical goods, that will live alongside Fortnite but be completely interconnected with Fortnite.
So what Disney's doing here is investing $1.5 billion in the video game studio Epic Games, who they're licensing their intellectual property to, for Epic Games to be able to create this digital Disney world of sorts, which will have games and familiar buildings and familiar logos and characters all inside of Fortnite's game engine. Disney's done collaborations with Fortnite in the past, and I think it's interesting how Iger detailed the prospect of selling physical goods inside this virtual Disney universe. This almost sounds like a Chapek era project that Iger has dusted off to throw at Peltz here to say, see, we're doing new stuff. And the reason I say that is because back when Chapek was CEO, I did a video talking about how I think Chapek and other Disney executives, they seem to really like that idea that one day Disney's out-of-the-house experiences, like the parks and the theatrical film releases and things like this, that it will all be done inside of a digital world, where people can consume all of that from home, where Disney doesn't have to lose almost all their revenues to labor costs. All this would allow Disney to make much higher margins compared to the physical parks, for instance, and all the expenses that go along with physical experiences, in particular labor costs and other operating costs. Imagine if all of Walt Disney World is inside a computer, it was in some sort of digital world where Disney did not have to do that much maintenance on it, it didn't cost much to maintain, and it was just as popular as the physical parks. Now we know that dream, it's likely impossible. Now Iger isn't creating a Disney metaverse here to replace Disney World and Disneyland or anything like that, but it is quite an interesting prospect where on the earnings call he repeatedly mentions the idea of going into this digital Disney universe, shopping for physical goods at digital gift shops inside of this Disney video game universe. We know that Disney shut down the Disney stores that they had all over the country, all over the world, the brick and mortar ones, to reduce expenses. And I do feel like this kind of sounds like a Chapek idea, selling all these physical items inside of a virtual world. All in all, I think this Epic Games collaboration is a really good idea if Disney's serious about it. You know, in terms of reaching out to Generation Z and Generation Alpha, who on average in America, I do not believe that those two generations, these younger generations, have the same connection to Disney that millennials do, who are now approaching or in their middle age. You know, they grew up during the golden age of the Disney Channel and the content renaissance. I see with my own channel, the majority of our demographic is millennials and Gen X, who have this very, very fond connection to Disney from the time that they were a child. Now, I'll tell you, I am a member of Generation Z, but probably not one that is, representative of the whole by any means, where I went to Walt Disney World as a kid, and I was really, really impressed with what I saw, how it functions as its own city, and really everything that goes into making Walt Disney World in particular so special. I didn't come to it from the angle of loving the movies or the Disney Channel. I grew up watching Thomas the Train, and then I went to Disney World, and I was like, wow, the detail in here, the history behind this, as I dug into it, as I got older and older, and I started making all this content, where from the time I was 12, I was making YouTube videos, highlighting different things at Walt Disney World that I really thought were cool and quite impressive feats. That's sort of the angle that I came to it from, and I don't think that most people in Generation Z or Generation Alpha had that same sort of experience where they grow up and it's all about these online games. They spend a ton of time on them, and Disney does not have a particularly great presence in that world, largely thanks to Bob Iger. Iger's story here, Iger's the one who's saying that he recently happened upon these numbers, where he found out that Generation Z and Generation Alpha, they spend so much time on video games. Here's the thing, this was something known 5 years ago. This was something that was anticipated 10 years ago. And do recall, Bob Iger is the same guy who for decades has canceled, has canned, has otherwise basically destroyed Disney's ability to put out in-house gaming projects. There are very ambitious projects that Disney has conceived of to really capture this demographic in the past that he ended up axing. You might recall he axed Disney Infinity and abandoned game publishing over a $147 million loss, which might sound like a lot, but that is a number that pales in comparison to the losses we see today, not just with Disney Plus, which is billions and billions in the hole, but even with things like the Star Wars Hotel at Walt Disney World. I'm pretty sure they lost more on that than they ever did on Disney Infinity. I think they could have afforded to lose more. These game studios, they lose a lot more than $100 million before they start making a lot of money. You have to make a pretty serious investment to establish your place in this very competitive market. So even though Iger has not stomached ambitious gaming projects at Disney well in the past, the track record isn't great or anything like that. The interesting thing here is that Disney is leaving it to an outside firm to incur costs and figure out how to make this sort of thing, this sort of virtual Disney World, a success, which could prove to be a good strategy on Iger's part to bring Disney's experience to younger audiences without investing tons of money towards that end himself. By letting a third-party company put this all together and put this out there, you might garner fans who become fans of your intellectual property, who then end up going to the parks and paying Disney in other ways. That helps make this equity investment worth it, and it's something where Disney does not have to directly pay for the day-to-day development of it. By the way, one last note on this, Iger says that this is all years down the road. He said something like that when he was talking about Epic Games, and when he was being asked about details, they were very stingy on details, which Peltz, the thorn in Iger's side right now, he definitely pointed that out, and we'll get into all of that later here in this video. Also on the earnings call, we heard about Disney's latest plans with ESPN. ESPN is creating a combined streaming service which will feature content from Warner Brothers, Discovery, and Fox. Disney plans to make ESPN's current cable channels part of another streaming service coming fall of 2025. Also note they also have the cable packages, and they also have the ESPN Plus service, which is already active. So it's a bit confusing here. There's all these different ESPN services. There's probably more that I don't even know about. I'm not an expert in this field. And on the earnings call, Iger said that they are in productive talks with content and marketing partners to do even more collaborations and get ESPN involved in other things in other ways. So ESPN is all over the place here. And I pointed this out on Twitter after the earnings. I may be a little biased on this, covering the parks and all, but half the earnings call was dedicated to sports, to streaming, to all these businesses which make little to no money, at least right now. If you take a look at this visualization of Disney's earnings created by Economy app, they do a great job. You'll see all Disney segments, they all bring in a ton of money. But at the end of the day, once you run that through the filter of all the expenses that it takes to run the business, what makes the company money at the end of the day, it's that green stuff that you see on the right side. Of course, that is Disney's income. And you'll notice once you run all the segment revenues through all the operating costs and all the other expenses and come out the other side, it is Disney's parks and cruise lines that consistently generate cash for this company. They are pretty much the only thing that generates consistent giant sums of money for the company. The same cannot be said about entertainment, where it ebbs and flows quite significantly. And the same cannot be said of sports, where it seems Iger's focus is right now. It's been the bane of my existence covering Disney the past decade. They've always had this particular investment philosophy, which is take profits from what's working, the parks, and invest it in what isn't working. And why Disney does this is they're trying to focus on growth, focus on growing the poorly performing parts of the business by taking money from the things that are performing well. And this may sound like a smart business strategy. I'd argue on a shorter time frame, it's a great investment strategy so long as you start to see it yield results. However, this has been Disney's strategy the past 20 years under CEO Bob Iger. They take all this income that the parks brings in and they throw it into these other segments that do not yield consistent results. That's why we talk about if the parks were to ever be spun off into their own independently operated company, we'd be getting new rides, new lands, all that stuff much more often because the parks are bringing in tons of income. And what do you do with that to make more income? Well, obviously you invest it in what's working. You invest it in your parks. Instead, it's clear Disney's executives are focused on the studios chiefly and then the sports. And don't get me wrong, Iger knows that the parks are very important. He says that a lot in interviews, but it's that thing that's down the road. It's that thing that's over in the Florida swamp that's making tons of money already, which we can use to then invest in all the stuff that we do care about, like sports, like Disney Plus, these things that aren't showing returns. And I find that to be a very interesting investing strategy and one that I'm not particularly a fan of there. At a certain point, they need to reinvest in what's working, the parks, and stop giving our good money that we spend on good experiences to parts of the company that consistently lose the money that they are given. Looping back around to the parks and what was said about them on this earnings call, Disney said there are many untapped stories waiting to come to the parks. They plan on spending approximately $60 billion on the experiences segment over the next 10 years. What's new is now Disney has elaborated on this $60 billion number. Of course, under the experiences category, there's a lot of things. It's not just the theme parks. You have hotels, you have the cruise line, which Disney is rapidly expanding. So in this new earnings release, we found out that Disney plans to allocate approximately 70% of that $60 billion over the next 10 years to incremental capacity expanding investments at the parks around the globe. That is what Disney said there. What's interesting is in Disney's filings with the SEC, you'll see that these investment numbers that they're throwing out there, they come with disclaimers. They are projections. So this $60 billion, this investment, it could end up being considerably less than that. It could end up being considerably more than that, or it could end up being nothing. The number is forward-looking and actual results may vary wildly. So Disney isn't being held to this number or anything like that, which has led to many fans online saying, hey, this is just a fig leaf that Iger's throwing out there, waving in our direction, perhaps in an attempt to dissuade voters from going off of the script and voting to put a dissident investor, Nelson Peltz, on the board. It should be noted that a lot of Disney's recent statements and announcements involve these broad investment numbers numbers with very little in terms of detail or promises that they can actually be held to. So it could be the case that some of this is just ammo that they're producing to throw back Peltz's direction. We're going into this contested annual shareholders meeting. Disney can say, hey, look at all this stuff that we are thinking of doing, that we are planning on doing, and then once Peltz fails and competing for shareholder and fan sentiment is no longer important, these Disney executives go back to their business as usual for another year. However, personally, I do believe that Disney will be spending money at the parks over the next 10 years. I mean, they have to. First of all, there's tax incentives for doing so. Also, you need things to hype people up to spike capacity at underperforming parks, in particular Disney's Animal Kingdom at Walt Disney World. That being said, if you review Disney's statement that this $60 billion to be spent on experiences over the next 10 years is around double what they spent the past 10 years, which sounds awesome, but then you factor in the fact that only 70% of that is going towards the parks. A lot of it is going towards expanding the cruise line. Now we're left with $40 billion. And then if you factor in inflation from the past 10 years versus the next 10 years, and factor in that the investment focus will likely be international, and also it includes things like these DVC properties that Disney builds every year, lots of other stuff that you may not initially think of when Disney says capacity expanding investments, resort rooms and all this sort of stuff, you'll start to realize we're not currently talking about doubling Walt Disney World's or Disneyland's capital expenditure over the next 10 years once you adjust that for inflation. It is not going to be that dramatic of an increase in investment. I don't mean this to make you sad or anything like that. I just am trying to point out that once you do the rough math on this proposed hypothetical number, this approximate investment that Disney wants to do, I don't see any money in here for a fifth park at Walt Disney World, for instance, which has been a rumor lately. However, I do think that we are likely looking at least 3 big land expansions over the next 10 years at Walt Disney World, or in the case of Dinoland USA, land replacements. I think that the focus of investment at the Walt Disney World parks in terms of expansion and things like this, it's going to primarily center around Disney's Animal Kingdom, which needs a major attendance boost going into the second half of this decade. And then secondarily, I think the focus will be the Magic Kingdom, which has capacity problems. It's the most popular theme park in the world, and it needs more guest spaces to moderate crowds and satisfy demand, allow more people in and things of this nature, and of course increase ride capacity and all the rest. Of course, as I touched on in our last video, I believe that the current disagreement between Walt Disney Imagineering, the park's creative arm, and parks management, the park managers, the rumored disagreements and clashes we've been hearing about those two parties, I think that that has made it where Imagineering's future plans, they've been held in limbo for years. So even if there is some truth to Iger's interest in investing in the parks, even Walt Disney World in particular, Chairman Josh D'Amaro, the president of Walt Disney World, Jeff Volley, as well as the parks VPs that you have at each of the individual parks at Walt Disney World, and then of course Walt Disney Imagineering, the creative arm, they all need to come together and agree on what these investments at Walt Disney World will consist of, how much they'll cost, and what needs to happen. So we'll stay on top of that. Hopefully things move in that direction soon, and we'll finally get some actual funded projects in the works at Walt Disney World, not just ideas. In the Q&A on the earnings call, Iger was asked about a fifth park at Walt Disney World, which he did not directly respond to, and he elaborated that the investment at the parks, that 70% of the $60 billion, it will be distributed all over.
We're already hard at work at basically determining where we're going to place our new investments and what they will be. You can pretty much conclude that they'll be all over, meaning every single one of our locations will be the beneficiary of increased investment and thus increased capacity.
We plan to invest approximately $60 billion into the business over the next 10 years, of which approximately 70% is earmarked for incremental capacity expanding investments around the globe, which we expect to generate attractive returns.
To me, this is further evidence pointing towards there isn't money in here for new theme parks. What we're talking about here are incremental capacity increases, which is a fancy word for new lands, new rides, stuff like this, which all the parks around the world could take advantage of sooner rather than later. There was also a claim Iger made on the earnings call, which went something like that they're going to be adding capacity to the parks from 2025 on. Like every year, there's going to be new capacity at the parks from 2025 on. And I do want to say, at least as as far as Walt Disney World is concerned, if you look at the roadmap that Disney has in terms of the stuff that's coming to Walt Disney World, I just don't see how that's the case. It takes a while to build stuff. Disney has not announced any sort of big new expansion at Walt Disney World. It's possible that Iger also means hotel capacity. Of course, he's also referring to the parks that you have around the world. But the thing is even with something like Tiana's Bayou Adventure, that's an existing attraction that is down right now. On a technical level, it's down for refurbishment. Once it comes back online, that'll just mean that Magic Kingdom is going back to the capacity that it had before Splash Mountain went down for this update to Tiana's Bayou Adventure. So that is not an investment that added capacity to the Magic Kingdom. And that's the issue we have right now, where due to deferred maintenance costs and things like this, there's a lot of existing attractions at Walt Disney World in particular that need serious love, serious attention, overhauls and things like this, where you invest a lot of money into them, and at the end of the day, you just go back to the same capacity you did before once that experience reopens. You're not actually adding new areas or things like this, and I think that's why that Villains Land idea they have, that Beyond Big Thunder Mountain stuff they've been teasing, that is so pivotal to expanding capacity at the Magic Kingdom, because just doing things like updating stuff inside of the Magic Kingdom, stuff that already exists, that is not moving the needle in terms of reducing crowds, reducing lines, or making the guest experience more enjoyable. And as I said, when Iger says in 2025 on, they're going to be adding capacity to the parks every single year, he's probably talking a lot about the international parks, but even there, I feel like this is a difficult claim to substantiate unless he's just counting hotels. Is it possible that he's counting updates to Tokyo Disney, which they don't even own? Who knows, but we'll stay on top of all the latest here. Finally, getting to the latest on the Proxy fight itself, which is going on right now between Nelson Peltz and Iger, which was the backdrop for this earnings report that we just covered. These latest earnings, they were pretty good, so they don't put a lot of wind in the sails for Try and Partners Restore the Magic campaign. This is this dissenting group of investors who want to shake up the board. Disney puts out these numbers that look very good on their face, at least. They announce all these new things, these tentative ideas and things like this. The stock skyrockets. Peltz's whole campaign is predicated on Disney shareholders saying, look at my portfolio, this stock is doing terrible, Disney needs new leadership. So the fact that the stock responded so well to this earnings was not something that I think was particularly good for the dissident investor campaign here going into the annual meeting. And obviously there is no way that this windfall of new announcements and stellar reductions in spending and all these things that Wall Street all this coming in at once, it was definitely no coincidence. Disney has launched their Vote Disney website, imploring shareholders to vote for Disney's 2 new board nominees, and they're using Professor Ludwig von Drake as well as other Disney clips in a video telling shareholders not to vote for Nelson Peltz. Iger is featured in a video on the site calling this contested annual meeting a distraction. Listen to this.
I'm Bob Iger, CEO of the Walt Disney Company. It has been a busy and challenging time since I returned to the company, but we've made significant progress. All of this takes a lot of work and a laser-like focus on the task at hand, which is why the major distractions we're facing from activist investors are exactly what we don't need.
This sentiment, calling it all a distraction, is further reflected in the proxy materials Disney has now sent out to shareholders, where they state that Trian's dissenting group of nominees are not good. On the matter of Nelson Peltz, who wants to join the board, they say that Peltz has no media experience or strategic ideas, which is a bit of a strange claim considering that Peltz's definitive proxy filings contain lists of strategic actions that he would want to take if shareholders added him to the board. Strange also, Peltz's running mate, Jay Rizzullo, who was Bob Iger's own CFO for half of Iger's tenure at Disney, apparently he is suddenly no longer qualified on the matter of the Walt Disney Company. They say that his experience is stale because he left in 2015. Has the business changed that much since? Would Iger say that his 2015 self wouldn't be suitable to run the company today? It definitely has become a lot different with streaming and all of this, but even as of now, Disney and the executives have clearly yet to figure out that whole can of worms, how to do streaming or anything like that. So I found that to be a bit of an interesting critique there on Disney's part. While Disney has ramped up their campaign, so has Peltz. If you're wondering what Peltz has to say on the recent news from Disney about Epic Games, about cost reductions, about about dividend increases and all of this. Here is his take.
These are just a lot of empty promises. These are election day comments, okay? And Bob is talking like he just got into office a week ago. This is a management team that's been there for 20 years.
So taking a look at Peltz's materials, a lot of what he's been sending out to the shareholders, it highlights stuff that we have covered before, where Disney's stock has been underperforming the broader market. As Disney's performance has gotten more questionable over time, executive compensation has actually risen quite significantly. So they're seeing, more questionable results, yet they're seeing higher compensation, which could suggest some sort of misalignment between the motives of the board and the executives and what is best for the shareholders, which the executives have a fiduciary responsibility towards. I do want to make note of this. I think a big reason why Disney is so resistant to Peltz is I think that Iger, he's kind of made allusions to this. I think a lot of people at Disney think that Peltz wants to split up the current company. And the leaders inside the company, they do not want to do that. Also, it should be noted, Iger and Peltz also disagree politically. Peltz is friends with Isaac Perlmutter, who is friends with some other folks that I don't think Iger is too big of a fan of. But instead of just saying something about these actual reasons why they oppose Peltz, voicing these concerns that they have, instead Iger says that this campaign is all a distraction, which is odd because this campaign that Peltz is putting on, it's running on the very real concerns that shareholders have about the material performance of the company over the past decade. Those are distractions to you, Iger? It almost sounds like he thinks that the shareholders work for him, and he's saying, stop being annoying, stop bothering me, which is a bit strange there. These sort of snarky comments that Disney keeps putting out, saying that Rizzullo is stale and that this is all a distraction, it comes off in a certain way where you almost want to see some comeuppance, right? Maybe we should switch up the board because these guys in charge of Disney, they do seem pretty prideful here, attempting to dismantle the newest narratives that Disney's put out in the spotlight very successfully, chiefly the $1.5 billion investment in Epic Games. Nelson Peltz has just sent a letter to shareholders, a scathing one, where he states that Disney has announced a slew of new promises, which he terms a spaghetti against the wall plan, including with the letter this satirical illustration of Bob Iger in the boardroom throwing spaghetti at the wall, while his hand-picked board, who do not have much of a personal stake in the company, are sitting around the boardroom table on their phones, sleeping on the job, it looks like. Peltz says, quote, "Frenetic activity in the face of a proxy contest is not a substitute for a well-considered corporate strategy, nor is throwing spaghetti at the wall going to feed shareholders who have been starved of returns for so long. Disney shareholders need the company to consistently perform under the watchful eye of a vigilant board. That is the recipe for good eating. To improve the focus, alignment, and accountability of the board, Disney needs new independent directors. Help us elect Nelson Peltz and Jay Rizzullo, who pledge to ask hard questions, work with the rest of the board and management to develop thoughtful strategies, align the interests of executives with shareholders, and hold the leadership team accountable for performance. And to do so all the time, not just when the company faces a proxy contest." Last up in the news today, I want to take a second to remark on some interesting items in Disney's latest annual filing, their 10K filing that they do with the SEC. Every big corporation files these every year, and they always have a lot of interesting stuff in them. If you ever take the time to actually read through them, there's a lot of legalese and stuff that you can skip over, but there are some interesting nuggets in these. Part of what companies do in these 10Ks is they identify where their risk factors are, what potential problems are coming up for the company or could present a risk to the company, so shareholders can make informed choices in terms of investing in the company, in terms of how they vote at these annual meetings. So Disney's risk factors that Disney themselves highlights includes decline in economic conditions. Of course, if the broader market comes under pressure, the world comes under pressure economically, so too will Disney's earnings to perhaps a less or perhaps a greater extent than the overall markets. Another risk factor that Disney identifies is how changes in technology could affect their future performance. In this section, Disney details how out-of-the-house consumption of Disney's product has not resumed to pre-2020 levels, insofar as their theatrical releases are concerned, which they seem to be blaming, at least in part, on streaming and trends with digital devices. More interesting, Disney identifies developments in generative artificial intelligence and how those could, depending on how the laws develop around AI, help or hinder Disney's ability to make money off of their intellectual properties. Also very interesting, Disney says they face risks relating to a misalignment with public and consumer tastes. Disney highlights how important the perception of their brand is is. They also elaborate on how, for example, they could invest in a new ride for a theme park when the IP is very popular, and then by the time the ride actually opens 4 years later, it may no longer be as popular, and the results may not meet projections. And they reference the politics that they've become embroiled in, saying, quote, consumers' perceptions of our position on matters of public interest, including our efforts to achieve certain of our environmental and social goals, often differ widely and present risks to our reputation and brands. And what I found most interesting in this section was the risk that Disney faces in the intellectual property space. In this area right now, the laws seem to be in the process of being changed. The technology is advancing rapidly, faster than the laws are even changing. Disney says if existing laws on copyright change, of course that'll hurt their ability to make money off of their IPs. And even under current laws, this is now becoming an issue where they say, quote, the copyright term for early works, such as the short film Steamboat Willie from 1928, and the specific early versions of characters depicted in those works, expires at the end of the 95th calendar year after the date the copyright was originally secured in the United States. As copyrights expire, we expect that revenues generated from such IP will be negatively impacted to some extent. Then Disney talks about how it is expensive and exhausting to enforce their intellectual property rights around the world and how the landscape has been changing. With respect to AI, they say, quote, the availability of copyright protection and other legal protections for IP generated by certain new technologies, such as generative AI, is uncertain. Further down, Disney details the importance of their brand and how negative claims on social media could adversely impact them, saying, quote, significant negative claims or publicity regarding the company or its operations, products, management, employees, practices, business partners, business decisions, social responsibility, and culture, which may be amplified by social media, adversely impact our brands or reputation, even if such claims are untrue. Damage to our reputation or brands could impact our sales, business opportunities, profitability, recruiting, and valuation of our securities. Now, as I said at the top of this, every company identifies risk factors for their investors to consider. So some of these, they aren't a big risk or a current problem. They're just sort of things that Disney's throwing out there. Other ones of these are things that are currently impacting the business. In particular, the early Mickey depictions that are becoming public domain, that's a pretty big deal. The AI stuff, that could definitely be bad for Disney. If the law becomes that you can't copyright AI-generated works, that will impact Disney's ability to use artificial intelligence technology to produce their own works, or it could also allow others to get around Disney's intellectual property rights by generating stuff off of Disney's IP, creating an original work that the AI created that cannot be copyrighted by anyone. Lots of interesting stuff to ponder on here. Be sure to subscribe with those notifications on to stay on top of the latest happening with this proxy war, as well as whatever happens next over at the Walt Disney World Resort. I want to thank you all so much for making it to the end of this video. I really, really appreciate it. If you'd like to support the creation of these videos, you can head on over to mickeyviews.com/support to find out how. I want to thank our patrons over at patreon.com/mickeyviews for their financial contributions. We definitely need them right now with some things that we got going on over here at Mickey Views. So I very, very much appreciate anything that you can send our way for the continued production of these videos. Thank you guys so much. From the Mickey Views Magic Studio, this is Brayden. Have a magical day.